Closer-to-home Americans wake up to a stark new financial reality. We're no longer the gold standard as it relates to the world's economy. Yesterday, after the markets closed, Standard & Poor's downgraded the nation's long-term sovereign credit rating from AAA to AA+. It is a first for the country and an embarrassment for President Obama. In explaining the decision, S&P says the nation's growing debt, coupled with last week's political acrimony over raising the debt ceiling, gives them less faith in the nation's ability to repay its loans. It comes days after Congress cut the debt ceiling deal, shaving more than $2 trillion over the next decade. In essence, S&P thinks the deal fell short. After Standard & Poor's notification of the credit downgrade, the Obama administration fired back, saying the S&P's own figures were off by $2 trillion. S&P acknowledged the discrepancy, but says its decision to downgrade stays. So what's next, and where do we go from here? CNN's Felicia Taylor is live in New York. And as we said earlier, boy, this credit downgrade, Felicia, what a stunning wake-up call. Completely. I mean, it's totally unprecedented. We've had a AAA rating in this country since 1917. This now means that those countries that invest in the United States have a rating below that of Britain, France, Germany, and Canada. That makes it a riskier investment for anybody who's investing in the United States. So that's a problem going forward. But for consumers, for individuals, the reason this is important is that interest rates could go higher in the short term, meaning that any kind of an investment, whether it's credit cards, insurance payments, anything like that, is going to be at risk. That's why this is critical for every consumer in this country. It's not just about investors in the economy, it's about the entire country overall. And what Washington now needs to do is get back to work and figure out how that debt deal is really going to work out and satisfy the rating agencies such as S&P. You know, on some levels, given the bitterness of the debt ceiling debate, was this a way of the S&P saying, we don't believe in your ability, the leadership on both sides, to get a deal done, to create jobs, to cut where needs be, basically sending a message saying, if this is the way you're going to deal with the debt ceiling, forget about trying to create jobs. Was that part of the message? Completely. You've encapsulated it perfectly. That's exactly the message that they're sending to Washington, that the lack of consensus, the lack of bipartisanship is really what's at risk here. We Americans are not coming to the table and agreeing on how to get this country back into a recovery phase, because we're not. We saw a jobs number on Friday that really wasn't up to snuff. It was better than expectations, but not good enough. And we've had a couple of months that were kind of wild cards in terms of jobs, and that's what needs to be created. So the administration is being sort of, scolded and said, and being told, you need to come to the table and figure this out and get your ducks in order, so to speak, and understand that we're watching you. And from the S&P perspective, I mean, they've kind of put themselves in a hard place, because don't forget, they were criticized for not watching during the fiscal crisis and not minding the banks that were in trouble at that time. So they've had to step up to the plate and sort of say, okay, you guys aren't really doing what you need to be doing, and we're going to now call you on it. So there's a bit of a tug of war going on between Washington and the ratings agencies. All right, well, it's certainly going to be interesting to see how it plays out and to see if the leaders of both parties step up to the plate and do what needs to be done to get the financial house in order and hopefully, exactly, get the rating back. Felicia Taylor, thank you so much. We're going to check in with you a little later on. Appreciate it. Well, as we said earlier, this is uncharted territory for the U.S. economy, but one thing is certain. America's money crunch just got ratcheted up another notch. CNN Money's Poppy Harlow looked at some of the potential ripple effects from the downgrading.
Let's take a look at what this means for you, the consumer. Your home loan, you can watch your interest rates on your mortgage go up. More homes are going to then sit on the market. Prices of homes could fall even further to this already depressed housing market, and the only silver lining is for long-term investors who see a buying opportunity here. When you look at your car loan, very similar story. Expect your interest rate to go up, car prices to go up. It's going to be pretty tough for people with middle to lower credit scores to buy cars, and new car sales are going to fall. The car market isn't that healthy right now either. And then finally, when it comes to college loans, what does this mean for your college loan? When you look at interest rates, very similar story. Private student loans are going to see their interest rate increase. It's going to be tougher for students to get a loan for the spring term, so a very near-term effect here. Students are going to have to work more through college to pay off that increased interest rate. And finally, the only silver lining is most students have their financing for next year already lined up.
Poppy Harlow there for us. Well, now for the flip side, some analysts think that the credit downgrade may not have much of an effect on the market. Listen to what Chrystia Freeland, the global editor-at-large for Reuters, told our Anderson Cooper. The downgrade could actually have a positive impact on some investments.
Not just the U.S., which is in trouble. We're also seeing lots of sovereign debt issues in Europe. Ironically, the fact that the rest of the world is in trouble too is in the short term really to the advantage of the United States. PIMCO, the world's biggest bond trader, likes to talk about the U.S. as the cleanest dirty shirt. You have to put your money in somebody's treasuries, and right now the U.S. is still looking like a pretty good bet, and we saw that verdict in the markets this week.
Well, last night on AC 360, Standard & Poor's Managing Director John Chambers explained how lawmakers could have avoided this historic downgrading of the U.S. economy.
I think it could have done a few things. I mean, the first thing it could have done is to have raised the debt ceiling in a timely manner so that much of this debate had been avoided to begin with, as it had done, 60 or 70 times since 1960 without that much debate. So that's point number one. And point number two is it could have come up with a fiscal plan, similar, for example, to, the Bowles-Simpson Commission, which was bipartisan. Although it didn't have a supermajority vote, it did have a majority vote, and came up with a number of sensible recommendations. I mean, you could envision other recommendations, but that would have been a start.
The Bowles-Simpson Commission that Chambers talked about was the panel set up by President Obama to identify ways to reduce the national deficit. It's formally known as the National Commission on Fiscal Responsibility and Reform. Well, let's get back to breaking news out of